Hey guys, welcome back to another episode. If you truly understand where the correct support and resistance levels are, you can become a highly successful trader. That's why, in this video, we'll discuss how to beat the forex, stock, and cryptocurrency markets with support and resistance. This is a technique that can turn anyone who masters it into a highly profitable trader. I'll also share the auto support and resistance indicator that I consider the best right now. The idea is to fully understand this amazing trading strategy and use it to your advantage. Alright, without further ado, let's dive deeper into this topic in this video. So, the concept of support and resistance levels in trading is undoubtedly one of the most talked about aspects of technical analysis among experienced traders. As part of chart pattern analysis, these terms are used by big traders and institutional traders to refer to price levels on charts that tend to act as barriers, preventing the price of an asset from moving in a certain direction. The best trades often occur around support and resistance levels. No matter how you look at the charts, it becomes quite evident. Most big traders and institutional traders like to use support and resistance as their primary reference when predicting future market movements. On the contrary, many novice traders often lack a clear method to identify the right support and resistance levels and how to leverage them for profit in the forex, stock, and crypto markets. So, in this video, I will show you how to build a systematic trading approach using support and resistance. Are support and resistance strategies the best for trading stocks, forex, and cryptocurrencies? Based on my experience as a trader, I consider support and resistance to be one of the best market analysis tools, almost never overlooked by big traders when analyzing the market. Support and resistance levels, or support and resistance zones as often mentioned in price action books, are essentially areas in the market where prices are likely to reverse and move in the opposite direction. They are depicted on charts using horizontal rectangular shapes and are identified by looking for times when several reversals occur from similar points. These areas serve as valuable markers in identifying entry points, exits, stop losses, profit-taking levels, and risk-to-reward ratios. Understanding support levels. Support levels represent price areas where an asset struggles to drop below during a specific time period. Think of support like the floors of a building that are difficult for anyone to break through. If a ball falls on that floor, it bounces back up. And if the ball manages to break through the floor, it can freely move down. So, in trading, a support level is a price area where demand or buying power is strong enough to prevent further price declines, just like the building floor we mentioned earlier. Psychologically, the formation of a support area in the market happens when prices approach this area, making the asset seem cheaper and even too cheap. Buyers then see this as a great opportunity and are more inclined to make more purchases. If what's being sold is limited and more people are buying, the price automatically prevents itself from falling below the support area or even bounces back up. Understanding resistance levels. Resistance levels represent price areas where an asset struggles to rise above during a specific time period. Think of resistance like the roof of a building that's tough to break through. If a ball is thrown up and hits the roof, it bounces back down. And if the ball manages to break through the roof, it can freely move higher. So, in trading, a resistance level is a price point where the desire to sell an asset is strong enough to prevent further price increases, just like the building's roof we talked about earlier. Psychologically, the formation of a resistance area in the market happens when prices approach this area, making the asset seem more expensive and even very expensive. Asset owners then see this as a great opportunity and are more motivated to sell the assets they hold to enjoy profits from the sale. If what's being sold increases and there are fewer buyers, the price automatically prevents itself from rising above the resistance area or even bounces back down. Now, let's learn how to identify the correct support and resistance levels. At first glance, the steps may seem quite simple, but in practice, many traders struggle and make mistakes when finding support and resistance zones. So, if you're having trouble or often get it wrong when determining support and resistance areas, don't be discouraged. Because after following this video, you will soon understand how to pinpoint the right support and resistance areas and how to use them in the markets. There are many ways to identify support and resistance levels on charts. In practice, some traders may use indicators, but we prefer to draw them ourselves because it yields more accurate results. However, the use of support and resistance indicators can also be very beneficial if you want to quickly analyze markets with a large number of assets. I also use indicators for that purpose and then follow up with manual support and resistance analysis on the best performing assets identified by the indicator. In the end, after you understand what I've taught in this video, identifying support and resistance areas is a skill that develops over time through practice and analysis. Step 1. Start with a clean chart. When we talk about support and resistance, we're discussing the price action, nothing else. So, the first thing we need to do is get rid of distractions and focus our analysis solely on the market's prices. In practice, indicators tend to confuse traders about what's really happening. This especially happens when a trader uses multiple indicators on one chart. The complexity of these overlapping indicators makes traders believe they see things that may not actually be there. Therefore, as a starting point, when drawing support and resistance lines, keep it simple and start with a clean chart. Step 2. Identify all the highest and lowest points. The basis for forming support and resistance areas is finding swing highs and swing lows. Swing highs and swing lows are turning points in the market. These are places where the market has shown more buying or selling pressure, causing it to either move further or change direction. So, this is where you need to draw lines at every highest and lowest point you see on the chart. The important thing here is to draw simple lines at all these low and high points. It shouldn't be influenced by personal opinions. This way, the support and resistance areas you create later will be accurate and recognized by all traders. This is a crucial step to master if you want to determine support and resistance areas in the markets. Step 3. Connect the highest and lowest points on the chart horizontally. The final step in drawing support and resistance areas is to connect the highest and lowest points you've identified with a horizontal rectangle. This rectangle will become your main support and resistance area. The areas you draw don't have to be exactly at one highest or lowest point you've identified. So, whenever you can connect two high or low points, add a horizontal rectangle. Once you complete this process, you can be confident that the rectangle represents a clear support and resistance area that's accepted by all the major traders active in that market. Step 4. Simplify your support and resistance. This is an important step known mainly by professional traders and rarely known by beginners. This is one of the reasons why beginners often make mistakes when using support and resistance in their trading strategy. So, now, remove all areas that are not close to the current price. The reason is that you don't need them right now, and they will only confuse you. If the price jumps dramatically, you can always redraw your support and resistance areas. But for now, focus on levels that are only a few pips away from the current price, and pay more attention to levels that have shown strength or have been tested twice or more. And now, I will show you the most effective way to trade with support and resistance. In this discussion, we aim to make everything easy to understand, so that you can become a skilled and profitable support and resistance trader. In our Trading at Trader DNA, we've divided how to trade support and resistance levels into two simple ideas: bounce and break. So, let's get started. I will show you the most effective way to trade based on support and resistance levels. Once you have identified the main support and resistance areas that you and other experienced traders will be watching, the next step is to pay attention to signs that these levels will either hold or be successfully penetrated by a strong price trend. First, the bounce. In the first part of this video, I've already explained the bounce, like a ball dropping to the floor of a building and then moving back up. That's what we mean by the bounce. It's one of the methods for trading support and resistance levels, specifically done right after a bounce occurs. Many beginner traders make a mistake by placing their orders directly at support and resistance levels and then just waiting for their trades to happen. Of course, this might work occasionally, but overall, it can be very risky and a waste of your money. This trading method assumes that support and resistance levels will definitely hold, and prices will bounce back like a ball before they actually reach those levels. You might be thinking, why don't I just place my entry order right at the line? That way, I'll surely get the best price. We don't recommend such a risky trading approach. What we do when using the bounce strategy is always to increase the probability that prices will move in our favor. We look for confirmation through price action that indicates support and resistance levels will hold and a significant bounce will occur. For example, in this chart, if you intend to sell, you should wait for confirmation through price action that shows the price has bounced from the resistance level before entering the market to open a sell position. By doing this, you avoid unnecessary losses that should not happen due to the impulsive nature of beginner traders. From my experience, trying to catch a falling knife when trading forex, stocks, or cryptocurrencies can be extremely risky. Never make such careless mistakes. Second, the break. Ideally, support and resistance levels are assumed to last forever. Based on this theory, in a perfect trading world, we could enter and exit whenever prices reach these major support and resistance levels and make a lot of money. However, in reality, these levels can be broken and often are. So, as a trader, it's not enough to only focus on bounces. You also need to know what to do when support and resistance levels are breached. In our strategy, we see two ways to approach trading breakouts of support and resistance levels: the aggressive way and the conservative way. The aggressive way or support and resistance breakout strategy. The simplest and proven effective way to play breakouts is to buy or sell after a convincing breakout of a support or resistance zone, as confirmed by the formation of a strong bullish or strong bearish candle that successfully penetrates the support or resistance zone. The key here is convincing because we only want to enter when the price strongly and smoothly passes through significant support or resistance levels. The support and resistance breakout strategy involves the following steps. Step 1. Identifying the direction of price movement. If there's an uptrend, we should expect a resistance breakout. If there's a downtrend, we should expect a support breakout. Step 2. As soon as a strong bearish or strong bullish candle truly breaks through the support and resistance levels, we open a position on the next candle. In the case of a resistance breakout, we open a buy position, and in the case of a support breakout, we open a sell position. The conservative way, also known as the support and resistance retest strategy. If you feel uncomfortable entering the market right after a breakout, the best approach you can take is to wait for the price to do a pullback to the broken support or resistance level, and then enter after the price bounces, while observing the formed price action as confirmation of the bounce. Here are examples illustrating this strategy. The most effective stop-loss placement when using support and resistance trading strategies. Once again, it's important to remember that support and resistance levels should be thought of as price zones, which can sometimes appear a bit unclear. Prices actively interact with these areas. For this reason, it's why experienced traders always place their stop-loss orders outside of these zones. The auto support and resistance indicator I recommend. As I mentioned earlier, the best way to analyze support and resistance is manually, because the support and resistance levels you determine are more accurate than those determined by an indicator. Therefore, I use the auto support and resistance indicator only as a simple tool to speed up my analysis of multiple markets and different time frames quickly. I then follow up with manual analysis on potential markets based on the auto support and resistance indicators analysis. If you need the auto support and resistance indicator that I use, you can download it from the video description area. I've included a template with the system that you can easily apply to your chart, and it will automatically display all these indicators accurately on your charts, so you don't need to worry about anything. Get the download link in the description. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or X to show your support. See you next time.